like in the US, there are certain states which are one-party consent state, which is basically you don't need any kind of consent. But in certain cases, you need two-party consent. So these are all legal aspects, because recording people is quite important in life. Many times people have to record others, but you have to be aware wherever you are, look at the legal position. And certain states are actually two-party consent states. So that you have to be aware of. Okay, let's go back to page 39 and look at. Yeah, so I was just objecting to this statement, these kind of statements, since she's sure of full repayment, including the 6% interest return. That's not really correct unless you are able to reinvest the proceeds of the interim proceeds on the fixed income security at the YTM. Only then will you get the total realized return of 6%. Otherwise, it will be less or more. It could be more as well if you get lucky. All right, so that's where we ended. Now here, there's another statement here. Again, you see these talking about these typical asset allocation kind of decisions, how to divide the fund between high-grade bonds or other so-called cash equivalents. Cash equivalents are essentially like money market funds which invest in treasury bills or commercial paper. Commercial paper is a little bit risky because it's a corporate credit, but treasury bills is government obligations. So those are considered to be a cash equivalent. Okay, so like for instance, in U.S. brokerage accounts, when you're posting initial margin, you will come across initial margin later on when you study futures. When you post initial margin in U.S. brokerage accounts, you can post them in T-bills as well, treasury bills, because treasury bills are considered to be cash equivalents. So you can post it in treasury bills and enjoy that return as well while maintaining your margin. But of course, if you suffer losses, and you have to submit, you have to post what is called variation margin, that has to be posted in cash. It can't be done in treasury bills. So so this is what you have to remember as cash equivalents. Okay. So and leading DJ stocks are basically how do you split the fund between high grade bonds and this? What course should the investor follow? Yeah, so what they're saying is that, okay, so what should he do? Now he's saying that, okay, there's, and then he's saying that the defensive investor should be able to count on the current, this return, okay? And also on an average appreciation of 4%. Well, actually, let me make a few other statements, okay? These are all very dangerous statements. He should not be making these kind of statements. You can't count on anything, okay? If there's one thing you should learn about the markets is that you can't count on anything, okay? Everything is just about kind of like a guess. It's a bit like, whether we'll be alive or not. Who knows? Like next month, should I make some statements like, oh, I'll be definitely alive for the next 20 years? Who knows? Nobody knows. So we should not be making these kinds of loose statements for which we don't have any basis, okay, to make these statements. So you can't count on anything, okay? You can say, okay, fine, the current dividend yield is 3.5%, but if the stock starts to fall, then your price depreciation is going to wipe out your dividend yield, okay? So your 3.5% dividend yield is because your current dividend divided by the current price. But if the price falls, then if it falls more than 3.5%, then this is, bye-bye. I mean, even if they pay the dividend as they've been doing now, until now, you've lost so much money on your price depreciation. Remember the two sources of return, okay? So you can't count on anything. Let's write this here, this way. Other than pure executable arbitrage trades. Okay? Pure executable arbitrage trade means where you can lock into all the prices. Okay, arbitrage as in CRA, classical riskless arbitrage. That is, you can see somebody willing to buy or sell an iPhone for 65,000 rupees. He's willing to buy or sell at that price, and then you can put together an iPhone at a cost of 30,000 rupees. So you put together the components, and it costs you 30,000 to put together the components, and instantly you lock in all the components and the labor and everything, and then instantly you sell to him at 65,000. So you've locked in your 35,000 profit, and there is no problem. You can make the transportation happen. You can ship the iPhone to the guy you sold it to, and that's it. That's a locked in, pure executable, pure executable is in brackets. I mean, you have to be able to execute the arbitrage. Okay, if I now suddenly put a barrier between, that prevents you from transporting the iPhone that you assembled and selling it and sending it to the guy to whom you sold the iPhone, then you're dead. Your arbitrage is gone because I put up barricades. You can't transport the iPhone, so you can't make delivery on your sale, right? If you can't make delivery on your sale, you don't have a sale. So you're gone. Your arbitrage is gone. That's why I said executable. The path has to be open for you to execute the arbitrage. So these are very rare in life. So other than pure executable arbitrage CRA trades, nothing. What is the expression that he used? How they speak in the US, you can't count on nothing. Okay, you can't count on anything. Okay, or economies actually. If you just say that, okay, industrial production is definitely going to rise for the next 3 years, you can't really say that. You have no basis for saying that. Nobody knows what's going to happen. So this is a very important thing, because you will not see this message pretty much anywhere else. I don't think anybody else is going to tell you this so emphatically, but this is very important as part of your education. You need to understand how unpredictable the real world is, so that you don't go out there and get hurt by thinking that some financial models are going to save you. So you have to understand this clearly, and pretty much nobody else will tell you this. Therefore I should tell you this. Okay, and also an average annual appreciation of 4%. Okay, yeah. So what he's talking about here, average annual appreciation of 4%, is basically the. Ayush Agarwal wants to enter. Okay. Okay. So what he's talking about here, this part here. Now, what happens here? Anybody has any kind of confident ideas? Now, this meet.google.com is irritating me nonstop. Now, if I block all notifications, what could be the downside from this? Is there any downside? Am I going to miss something? Not really, right? I don't have the guts to do it in case I block out some important notification. I'll just keep doing this for the remainder. We have 6 more sessions, I think. So we'll just keep doing this. I don't have the guts to do it in case something important gets blocked out. Okay. All right. So let's get back to this. So this 4% average annual appreciation of 4% in the stock. Where is this coming from? Okay. This basically is coming from the idea that, yes, he's already mentioned this. This appreciation is based, the expectation of this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. Okay, so what is this point here? So the assumption here is that 4%, let me write this down. Okay, Viveka wants to come in here. Okay, 1 minute. Minimize. All right, that's good. Okay, let me write this here. What is this here? Average annual appreciation of 4%. Okay, let me just. Okay, so this as he says, is talking about is based on this expectation is based on the reinvestment by various companies of a corresponding amount annually out of undistributed profits. Okay, so what he's talking about is, I don't know if there's anything in the footnotes here. Yeah, okay. So what he's talking about essentially is the growth rate. There's an expectation, there's an assumption. This assumes that that stock price, there's an assumption of market efficiency here, that stock price appreciation will track the rate of growth of earnings. Okay, so again, there is no guarantee. So there's an assumption here that you have to understand. This assumption is that the stock price appreciation, why is he talking about stock price appreciation of 4%? Because he's assuming that the rate of growth of earnings is going to be 4%, and therefore he's actually referring to this, okay, that the growth rate in EPS, normally we have this expression that we use in finance. As I said, it is better to discuss it as growth rate in earnings, not EPS, but most people will discuss it as EPS. So I'm teaching it to you as EPS. This requires that the number of shares as you know, that the number of shares need not remain constant, obviously. That's why I don't like to talk in terms of EPS. I like to talk in terms of earnings, okay, total earnings, not EPS, because the EPS is affected by the number of shares outstanding. And if you have stock buybacks, if you have, rights issues, all kinds of transactions these are all primary market transactions. All of these can affect the total number of shares outstanding. All of these can affect the number of shares outstanding. So it's better to talk in terms of not growth rate in EPS, but growth rate in earnings. But since the market talks like this in terms of EPS, we need to make sure that you understand it as EPS as well. But the assumption here is that number of shares outstanding remains constant. So the growth rate in earnings, essentially, let's conceptually understand it in terms of earnings. The growth rate in earnings is basically, this is the formula, that the growth rate, you can see it's logical. The growth rate in earnings is equal to the retention ratio plus the times the return on equity. ROE is return on equity. So retention ratio is what? Retention ratio is retained earnings in the previous period, okay, divided by net income. So whatever, if you earned like 9%, if you earned say $100 million, and out of that you paid out dividends of, if your net income was 100 million and you paid out dividends of say 40 million, so then you have 60 million here. So 60% is your retention ratio. Okay, so 60% is your retention ratio, and you have, if we just open this here, maybe we can even open your spreadsheet if required, but it's pretty simple here to understand. Retention ratio is retained earnings divided by net income. So 100 million net income, 60 million retained earnings, because you're paying dividends of 40 million. So therefore 60% retention ratio times on that on that block of retained earnings, you're earning whatever you're earning. Let's say your return on equity is 15%. So then it's that 60% into 15%, and that becomes the growth rate of your earnings. Okay, it's a logical formula. So this is what you need to understand, that there is a certain amount of technicality here. He's actually referring to this kind of formula for estimating the growth rate in earnings. Usually the market does it in terms of earnings per share, but you know why I tell you to not look at earnings per share numbers, I don't like it because you don't know if the number of shares is going to actually remain constant. So it's always better to look at the whole block of earnings or the whole block of book value. That's much better rather than book value per share, etc. So this is where, and you can always look at the return on equity that is being realized. That gives you a much better indicator, and without ever having to ever having to worry about whether or not, oh, what happened? Did they actually do some share buybacks? Did they actually have some rights issues? Did the number of shares actually remain constant? You don't have to scratch your head over that if you deal with the full block of earnings and the changes in the total book value of the company. So anyway, that's just a tip for your own analysis. But remember that the market is always going to be talking in terms of EPS. If you look at the earnings releases, they always talk in terms of EPS. All right, so this is just a little technicality to remember that there is this thing called the retention ratio into the ROE, the growth rate of earnings. Okay, so I think he's given you a name here for that. Yeah. So this is a slightly different thing. Okay, the future return is this current dividend yield plus the expected earnings growth. So here itself, you can see here from the Gordon equation that the future return. Okay, so your return is going to be consisting of two things. It's going to be the net yield. Okay, well, this is the gross return because you haven't taken your financing cost into account. Let's say your financing costs are zero for the sake of argument. Then your current dividend yield is your net yield. Okay, it's not the gross yield because your financing cost is zero. So the gross yield and the net yield are the same, which is the current dividend yield. And plus you have the price variation component. Now here he's saying expected earnings growth. That's why I said that there is you need to be careful when you're using this Gordon equation. When you're using this equation, you have to understand the assumption that the stock price appreciation is going to track the rate of growth of earnings. Okay, that's the critical assumption. So in real life, it's mathematically true that your total return is going to be a function of your net yield. In this case, we assume zero financing costs. Your total return is a function of your net yield plus the price appreciation, or price variation in general terms. Okay, and here price variation has been replaced by expected earnings growth. And that clearly tells you that this assumption that I talked about, it basically brings your mind back to the fact that this assumption is being made that the stock price appreciation is going to track the rate of earnings growth. Because logically, mathematically, what you should have here is the stock price appreciation. But Gordon has replaced it with the expected earnings growth because there is an implicit assumption in this Gordon equation that stock price appreciation will track the rate of growth of earnings. Okay. In general, you see that happening a lot of the time, but you can't really expect it to be true mathematically all the time. Like everything else, pretty much everything else in the markets, nothing is guaranteed. So this assumes a certain amount of market rationality that as the earnings grow, the stock price will also grow. And there's no real guarantee that it will happen. Okay. So if you read that book by Peter Lynch, you'll see that the very good book, actually. You should read that. It's very easy to read. It's one of the few first books you should read. One Up on Wall Street by Peter Lynch. I mentioned it in the last class. Very nice book. And so you'll see Peter Lynch always talks about earnings. Okay, growth rate of earnings. So in general, that should be the case, but not always true. You can't really expect anything to be that mathematically precise in the markets. So because if it's not tracking earnings growth, maybe there's some other concern which you're not aware of. And really, there's no way for you to force the market to make the stock go up in line with earnings growth. Okay, so you have to remember all that. So these things, all right, so this is just a point I want to mention. So that's why I have said better discussed as growth rate in earnings, not EPS. Growth rate in earnings, not EPS. All right, so this is our page 39. Okay, now let's go on to, yeah, better principals and bonds are better protected, more certain than dividends. Here, if you remember your You should go back to your hierarchy of claims, which we studied in legal aspects of business under the Solomon and Company case, the payment of secured creditors, and the shareholders were wiped out. All that, even the unsecured creditors couldn't be paid. So therefore, obviously, bonds are better protected. Bonds are. I just need to take a sip. While I take a sip, you can invest in an SIP. That would be your short-term project. Okay. Interest, obviously, this is better. The bonds are more secure because they get paid first. Yeah, then this is again. He's talking about the various aspects of asset allocation. He's talking about all kinds of possibilities, etc. Here, there's nothing much to talk about here. Okay. You should be aware of this. Tips. Haven't I given you a link for tips? I think I've given you a link for tips. If I remember right, if I've given you a link for tips. No? No tips? Okay. 1 minute. I thought that Treasury tips, let me just give you a link for tips, and you can read Treasury Direct, okay? So inflation productive tips, okay? Tips are, this is happening to us on page 40. So we'll just mention something about tips, okay? Everything is. All right, so you can read this. These are actually inflation-protected securities. So you can read that. Tips are basically short form for this. Okay, this is basically right. It's an inflation-protected treasury debt. So here you get the real rate of return. I mean, you basically you realize whatever you bought it at. Okay, if you are able to reinvest at the same rate, then you get you don't have any inflation risk on these securities, because if there's any inflation, they will make it up to you, but they will basically blow up the principal for that period and make sure you get a return based on the coupon. They will adjust the principal. They can't adjust the coupon, but if there's some inflation in the period, sorry, there's something in my throat actually. Okay, so there's some inflation. They will blow up the principal. They will inflate your principal at the same coupon rate to ensure that you realize the rate of return that was promised to you, and inflation doesn't wipe it out. So whatever inflation happens, they will compensate for that in the return given to you. So it's basically inflation-proof return in tips. Okay, so I'm going to give you this is for your further reading. This is not a part of the syllabus, but this is for your own knowledge. You have to, okay, I've already given you the link, okay? So you can just open that up and have a look at it and see. We have this in India as well, but because the Indian bond markets are much more heavily regulated and we don't allow foreigners to come in and go out as and when they wish, Indian tips don't trade that actively, but we have this product in the Indian market. But they're very, very liquid. Whereas unlike the US, where it's very liquid, because the US is a free capital market, the currency is freely convertible. People can come in and go out as they wish, and that the The benefit of that is that you have tremendous liquidity in the US market. So if anybody wants to do anything with excess cash, the first place they go is the US market. So these are some of the things that our policymakers don't understand. The benefits of having free capital markets, the tremendous liquidity that you get, the lower transaction costs, and all kinds of other benefits, directly translating into higher growth. All these things they lose sight of. They're just afraid that there'll be too much speculation if we allow free capital flows. So anyway, so once again we go to So basically, he's saying that even though it may seem like bonds are very attractive, you can't put everything in bonds. Okay, and there's a mention of tips, so I've given you the link to tips. Yeah, it's constantly talking about the asset allocation division. Either you have 50-50 stock and bonds, or you oscillate between 25-75. Okay, these things we can actually look at. I mean, you can just take these decisions on your own based on your risk preferences and the market outlook. He's talking about basically what kind of returns have historically been possible, what is a realistic rate of return, etc. Okay, so he's talking about what kind of stocks you can invest in. Here you see that basically repeating the same point over and over again. So maybe this book could have been a lot shorter, because in many cases he has repeated the same point multiple times. So so what he's saying is that different types of returns. So he's saying that there's no real reason to choose between one type of index or the other. Because here you had a period in which the Dow went up by 36%, but the S&P 500 went up by 58%. But then what he's saying is that you could not have predicted this ahead of time. So essentially, what he's again saying is that they're pushing you into some extent into passive investing. So that's what they're doing, index-based investing. So and basically pushing you away from all kinds of any kind of speculative, what they consider to be speculative. Actually, everything is speculative. Even the so-called blue chip stocks are speculative. As you can see, a stock like General Electric is languishing. ExxonMobil is not doing too well. So these are all high, very, very marquee names of marquee companies. But marquee names in the corporate landscape, but all of them, they're all actually not doing too well. So these are all blue chip stocks. And so therefore, what he's saying is that you can't do, again, he keeps saying that you can't do better than the averages, etc. Same thing being then repeated all the time. Long fine blue chips. Again, he's talking about, what is he mentioning here? So what he's saying is, instead of here, the first thing he's talking about is we can talk about it on page 43. We can talk about is some of the basic approaches. Okay. Okay, so the alternatives are basically create own portfolio, by selecting your own stocks. To own stock selection. That's your own first alternative. Okay, that's what he's talking about here. That what can the defensive investor do? Yeah. So actually, he's mentioned this. So I'm just mentioning the first option, which is to create your own portfolio through stock selection, and the second is actually invest in well-managed. As he used the word something like that, the purchase of well-established and well-managed investment funds. Okay, well-managed investment funds, which we know as mutual funds. All right. So you can actually usually mutual funds, because we're talking about traditional investing here. We're not talking about hedge funds. You could technically also invest in hedge funds, but that would not be traditional asset management. That would be alternative asset management, right? And then what is the third one that he's mentioned? Three supplementary concepts. Okay, the first is purchasing shares of well-established investment funds. So we actually have one extra, which is you have to create your own portfolio, invest in well-managed investment funds. Then okay, so these are different types of funds. They're not really this. This is not really that different substantively from the mutual fund avenue. Okay, this is common trust funds or commingled funds. These are also operated by trust companies. So these are matters of differential legal organization. These are not substantively different from a investment strategy point of view, because these are also, they basically fall into the same bucket as mutual funds. So and then or if his funds use the services of a recognized investment counsel firm, well, it's basically it's how would you put the third option? Okay, well managed investment funds, into which we can including common trust funds. Okay. Putting those into the same bucket, common trust funds, the same thing, funds managed by others. Okay, and hire professional. The third type he's talking about is basically he basically hires it's a customized, it's like a managed account kind of so basically these are the list point options that he has listed, but it's the fundamental distinction is that there's only two ways to do it. Okay, either you do your own stock selection, okay, or you invest in other funds. Okay, now some of those other funds, so broadly, let me just summarize it here. Okay, pretty common sense actually, but these are fundamentally the two options. Rely on what happened. Yeah. So what you're doing is, if you either do take advice, it's a bit like basically paying somebody to do the research for you. Whereas here you're doing your own research. You do your own research. Whereas here you're paying somebody to do the research and tell you where to invest. Um, rely on advice or management. Or otherwise, you invest in a mutual fund where you're relying on professional management. You give it to a mutual fund or a common trust fund. Or if you're widening your scope to alternative asset management, you give it to a hedge fund. So in any case, all that is happening is that you're relying on some other professional for his investment advice or his management. Otherwise, in option one, you're managing it all on your own. You're not, maybe you're listening to some, experts on TV and all that. But at the end of the day, you're taking your own decision. You're creating your own portfolio through your own stock selection. This is the independent advisor. These are sometimes called self-directed investors by brokers like interactive brokers. They will call this self-directed. So the term in this case is self-directed investor, okay? In the sense that this guy doesn't need any advice. So sometimes you might actually have professional investment advice, like typically your broker like Merrill Lynch or all these guys. The brokers will tell you what to buy or sell, and you would rely on their advice and then buy or sell. So that's where you're relying on professional advice. So you're not if you're doing this, then you're not a self-directed investor. If you're self-directed means you just use the broker for execution, and all your research and all you do yourself. This research is done yourself, deciding how much to buy, when to sell, when to buy. All that is done by yourself. Okay, so these are the broad options. So he has actually given too many options because he's looked at a superficial level. He's not gone down to the substantive similarities between the different approaches. But anyway, this is what the book is saying. So then he's talked about dollar cost averaging. Yeah, this is dollar cost averaging is kind of, I don't know where you would put that. Okay, if you want to, yeah, you could, I guess. So these are basically, all of these are active approaches. Okay, dollar cost averaging is a kind of a similar, something like a passive approach, because it is kind of not trying to time the market in any way. All of these, 1 and 2, whatever. I thought I had a note on dollar cost averaging, but anyway, I was trying to save myself the trouble of writing that. Okay. Your smart Google is. Okay. So is a passive investing approach. Right. So now you understand the difference between passive and active. We already discussed it before. In active, you're always trying to select particular stocks. We had a long discussion on this anyway. We're just recapping those terms because sometimes it's not. It doesn't enter. Get into your brain the first time around. So active investing is where you're doing your own stock selection or you're relying on somebody's advice. In all cases, there is a desire to try and outperform the general market, the index, by being very smart about selecting the stocks and not going for a passive replication of what is there in the stock index. Whereas dollar cost averaging is, although it's not really indexing, but it falls into the category of passive investing approaches, because here you're not trying to time anything. You're not trying to time the market or do any kind of selection. You may have some kind of broad selection strategy, or you can do this with either investing in a broad range of stocks or investing in an index fund. But dollar cost averaging is definitely a passive investing approach because you're not trying to time the market. So, right, more shares when the market is, but the more shares is not really important. What is important is value. So, more shares or less shares is not important. So, anyway, so yeah, you see formula investing, these are all passive approaches, all the kind of index funds and all that, where you're basically saying that, I'm not smart enough to select anything in a profitable way. So let me just be kind of passive and keep investing regularly in a broad range of stocks or in an index fund. So again, talking about in inverse relationship to the action of the market, this again tells you that this is a mean reversion approach. All right. And this is now he's talking about the aggressive investor. Yeah. So here he's talking about the sentence is a little bit of a complex. The sentence construction is complex, but what he's saying essentially is what I've told you, that you can end up pretty much. Graham is pretty much one of the few people in the market who will tell you how difficult it is to make money. And so here you can see what I've told you, that you may put in a lot of effort into the stock selection and this and that, but you may invest a lot in your data feeds and all that, but you could still end up with losses. So it's a peculiar kind of a profession, investing in that sense. Not like being a lawyer or a doctor or an accountant. There, the revenues are much more predictable. Right? So he's now going to document certain things which people have done. Okay. So again, what he's saying that this is actually not correct. Okay. Again, he's because he doesn't like trading, so he doesn't like this term trading. So he's effectively talking as if all trading is done from a momentum perspective. So trading in the market usually means buying stocks when the market has been advancing, selling after it has turned downwards. So here he's basically saying that all trading is being done from a momentum perspective. This is not correct, actually. Okay, so you have to once again make a note about that. That page 44, we've made these notes before. That so all trading is not necessarily done from a or not necessarily done from a momentum perspective. If you see most of the technical indicators, I've given you the websites. Okay. Many traders, you have to remember this, many traders follow mean reversion approaches. If you see that, if you just look at technical trading, avoid having to write. Many traders follow mean reversion approaches. All right. All trading is not necessarily done from a momentum perspective. Many traders follow mean reversion approaches. If we just look at, for instance, just try to open this, we'll see most of the technical indicators. If you look at most of them, there's like thousands of technical indicators. Once you get into a technical software, you'll see so many technical indicators, and most of them are actually mean reversion indicators. So here we are looking at the euro. Let's look at some indicators. Yeah, let's look at some indicators. Okay. Now, Bollinger Bands are actually these are standard deviation based trading products. Most of these things are this is another momentum oscillator. Then if you see uh, MACD, okay, MACD can be used in different ways. If you look at momentum, this momentum is not the same as this is an oscillator, I've told you, okay? This is an oscillator. Now, if you see, this is always going to be used as a mean reversion approach, but you can use it for trading as well. There's actually no precise way to distinguish trading from investing. Okay, people like to talk like this in loose terms. They say that, oh, this is speculation and this is investing. But as I showed you earlier, if you really pin them down, you'll find that there is no precise distinction. So unlike, say, money markets versus bond markets, there's a very precise distinction. In order to be a money market security, you have to have initial maturity less than equal to 1 year, and you must not have any coupon. The moment one of these conditions is violated, if it's still a debt security, it becomes a bond market security. Very, very clear, very precise. You can't make such precise distinctions between speculation and investment and this and that. So these are all very loose statements. So it's not true at all. If you look at most of the oscillators, they are like this. If you look at RSI, the most famous of oscillators, if you look at RSI, okay, relative strength index, this is a um, again, RSI is used as a oscillator, right? So basically what would happen is they would look at this low in the euro. We can eliminate this one to make RSI look better. So if they would look at this and look at this low in the euro and look at this point in the RSI, the oscillator, and here you would have a lower low in the euro. The price makes a lower low, but the low on the oscillator is a higher low. So there's an oscillator divergence on the RSI. And so this would be seen as a bullish sign. So those who are who are trying to go long on the euro would wait for a sign like this. And then they would go long as the market started to move up after showing this kind of a bullish divergence. So it's a trading strategy. Okay. And as I said, there's no way to distinguish between, no precise way to distinguish between trading and investment and speculation and this and that. So therefore, this statement is not correct. Okay, so we have to make a comment about that because again, he's saying that so it reflects a misunderstanding of what trading is, and even a failure to understand that you can't really talk about trading and investment and speculation because the distinctions are not precise enough. Okay. Yeah, sell issues that they do not own but borrow through the established mechanism of the stock exchanges, right? So this you have to remember is short selling. Borrow and sell shares you do not own. Okay. First trade is a sale. Okay. You go net short. Okay. Net short. This is called net short. Okay. That means you don't have any long position that you're selling, but you're actually borrowing shares because you have to deliver the shares. So how would you deliver? You borrow the shares and then you sell the shares that you do not own. Okay, so the first trade itself is a sale. You go net short. This is called short selling. And there's another term that you should know because we have this problem in the US. This goes on quite a lot. You might have heard of the problems with Robinhood and some of the other, you know, Robinhood is a brokerage actually. Naked short selling is it's actually illegal. Okay, naked short selling is illegal. Unfortunately, the SEC has not been sort of aggressive about enforcing the enforcing the law on not doing naked short selling. So it's like, there are lots of people robbing shops, going around Delhi robbing shops, and the cops don't do anything to enforce the law. So that doesn't mean that robbing is okay or it's legal, but it's just that it's illegal, but the law enforcement authorities are not doing anything about it. So short selling without naked short selling is no, short selling without properly, as in following the proper procedure, properly borrowing the shares first. Okay, that is, it leads to what we call bad deliveries. Okay, bad deliveries or non-deliveries. So you can't deliver because you don't have you never even bother to borrow the stocks. Okay, bad or non-deliveries. So this is called naked short selling. It's totally illegal, and bad or non-deliveries. Basically, we call it bad deliveries in the market, but these are basically where there is no delivery of the shares, or whatever is delivered is not a legitimate share certificate. So therefore, it's basically like a non-delivery because you haven't delivered the proper item. So this is totally illegal, naked short selling. But of course, if people go around robbing shops and the cops don't do anything about it, then people can go on doing illegal things. So you have to understand these two terms. Short selling is basically borrowing shares that you don't own and then using the borrowed share to deliver on the sale contract. Okay, you enter into a sale contract, and then there's naked short selling, which is you sell without even borrowing the shares, and you end up with bad deliveries. So these are the two terms. These are terms that you should know. He's talked about them here. So you have this. Now we have this. We were a little bit hesitant to start this in India. We have this thing now. We have a stock lending and borrowing facility in India. You can investigate that. Okay, SLB. It's called SLB facility, stock lending and borrowing. You can Google it. Remember, for your Indian markets, all your textbooks have little sections on Indian markets. So not all your textbooks, many of them will have. This one obviously doesn't have, but I guess in the future courses, they will be using textbooks which have, most of the textbooks have some Indian market sections. So your job is to follow the news, business news in India, and figure out what's going on in the financial sector and the economy in general. And also in the textbooks, you read the Indian sections and make sure you're aware of everything that's going on in India. Okay, so the SLB facility in India, SLB stands for stock lending and borrowing. Okay. Stock lending and borrowing. All right, so this has been started now in India, but we were a little bit late to the game because we were also afraid that if we allow short selling, that will be bad for the market and all. Kind of stupid ideas, basically. Totally off, totally unable to grasp the beauty of free markets. So that's been the problem of the Indian regulatory story. So anyway, but at least we are there now. On paper, we have this. So we have the stock lending and borrowing facility in India. So technically, you can go short. So now here, let's look at what else he's talking about. Yeah, so when you go short, obviously your goal is, if you're going, oh yeah, sorry, I'm so sorry. I talked about the entire discussion on RSI without bringing the thing into the picture. Okay, so what I was talking about on RSI was that you use the RSI as, so nobody pointed it out to me that I was not showing you the proper chart. Are you guys there? I mean, is the call still on, or is everybody? Or is there some kind of?
Oh, yes.
Yes,
You're
sir.
there. Yeah. So you should have told me when I was confidently talking about. I had it on my right-hand screen, and the left-hand and the screen in front of me is what I'm sharing. Okay. So to the left-hand screen, and nobody told me anything. So what I was trying to show you is bearish divergence being used by traders. In this is in response to his statement that all trading is all trading is not necessarily done from a momentum perspective. So what I was trying to show you was here. Okay, why did I bring it there? Here. So I was trying to show you the euro. If you're a currency trader, you're trading the euro against the US dollars, against the US dollar. You see that the euro is declining. You're a mean reversion trader, so you're not inclined to sell it. You're waiting for a chance to buy the euro, and you use this very well-known technical indicator called the Relative Strength Index, or RSI. And so what you have is, this is like a monthly chart. You see a monthly. So this is a monthly 14-month RSI. So here you can see what they're doing is that in oscillator, because it oscillates between these two levels. And so you can see this oscillator, the way you use it, you have one low in the euro, and actually this low is lower. This low is lower than this low. But notice that the oscillator is diverging. Divergence means two roads diverged in a wood, so going in different directions. So there's a divergence between the price pattern, the asset price pattern, and the oscillator pattern. The asset price makes lower lows, and the oscillator makes higher lows. See, the corresponding low here is higher. The corresponding low here is lower. Okay, so here this is a higher low than this one, but here this low is lower than this one. So there is a divergence. Now, because this is a buy signal, this is known as a bullish divergence, because the implication is bullish. That is, the price is likely to go up. So this is a very common tactic used by traders to pick up this kind of move, basically, to pick up profits on this kind of move. That once the price reacts like this after a bearish divergence, this is a classical example of a bearish not a bearish divergence, but a bullish divergence. Okay, ending a bearish trend. A bullish divergence ends a bearish trend, and this is a very you could say it's a nice picture actually, because and remember, these are all real things. Okay, I'm not making it up. So this is quite a classical example of a bullish divergence on the euro dollar. So on the euro dollar FX rate. Okay, so so that's what I was trying to say, that it's not at all true that all trading is done from a momentum perspective, which what Graham tries to say. So it's amazing actually that this book has so many kind of clearly wrong kind of statements. Anyway, so yeah, okay. When you sell short, you obviously want to buy it back. If you're a short seller, you would want to buy it back later. If you go and let's say, this is not a good example because it's not an equity. It's not a it's not an equity. So let's say if you want to look at something like, maybe if you look at Micron Technology. Yeah, so if you want to sell short here, you would sell it short here, and maybe you're thinking of a price coming down to $40. So when the price here is 74, you sell it, and you don't even have the stock. You borrow it and sell it, and once it gets to $40, you sold at 74, and you buy it back at 40. And once you buy it back, you get the delivery of the stocks from the seller, and you use those that amount of stock that is delivered to you to settle your stock borrowing, which you did over here. Okay, so let's say you borrowed 5,000 shares and sold them, and let's say, for the sake of simplicity, the next day it drops to $40. So you buy back 5,000 shares, and the delivery that you get, you use it to settle your stock borrowing, and in the meantime you pocket the profit. So that's short selling. That's what he's talking about here, right? And you buy it back and at a lower price. So small investors try their hand at short selling, etc. So one of the things you'll notice is that a lot of he's been trashing the small investors, but if you're following the market news on places like Bloomberg and all, you'll notice that these days there's a trend for the Reddit stocks. Okay, small investors. So you can have this small investors. He's basically trashing the small investors, but you may want to do some Googling on the Reddit uh, stock traders and what they're doing. They're actually um, versus the big guys. Okay, so the Reddit, you know what Reddit is, right? I think there are two T's in Reddit, if I'm not mistaken. It's a social media website where it's a chat group kind of thing, I guess. So it's a discussion forum kind of thing. So there are a lot of these stock traders who get together on Reddit and then let's say, okay, let's go and attack AMC or let's go and short sell Tesla. And they do this, and these guys get together and they start attacking one stock or they buy up one stock. So these are retail traders, and in many cases, they're actually able to take on the big guys like the funds, etc. And maybe some of the funds have even gone bankrupt by trying to go against the Reddit stock traders. So this is a new trend that's happening. Uh, so you should be aware of that trend also. I mean, if you're listening to the news, you'll pick up on all these things. It's always being discussed in the news. So it's not really good to trash the small investor. Okay, number two, what are we discussing here? Several ways. Okay, so it's basically talking about bad behaviors. Okay, here Graham is talking about bad behavior. So everything he's listing here is bad behavior. Okay, so second is short term. Okay, so basically buying in anticipation of some good news. So again, he does not approve of this activity. Okay, that's what he's trying to tell you. I don't approve of this activity. So this is listed under all the bad behaviors. Long-term selectivity. Yeah, so he's talking about either selecting stocks that have done well in the past, uh, good earnings generation, or sometimes those which are not really earning money, like a lot of the tech stocks, but are expected to earn money. It's a little bit like the internet boom, what happened in the internet boom, that kind of stuff. Then, so he's basically saying that don't try to be so smart, okay? It's not an operation. So again, this is what he's talking about as investing. Okay, this is his definition of investing. Again, this is a very subjective definition. So he's saying stock trading is not investing. So don't do it. But then neither is investing, neither does investing give you any kind of guarantee. So it's not really a precise definition, as I said. So he generally trashes stock trading. Same old stuff, actually. The same ideas are being repeated. Let's see what he says here. So there are two problems, as he says, that human fallibility and the nature of it. So market, two problems. One is that he's not able to estimate the future. And the second is the nature of his competition, but he's basically talking about efficient markets. Okay, he's saying that either the market is very efficient, so it's already factoring in all the, whatever can be factored in from the currently available information. And the second is that there is a problem in prediction. Okay, both are. I would say that the first one is the bigger problem, because this second idea of market efficiency itself is quite a vague concept. I mean, what does it really mean that it's reflected in the price? Because we don't really have a well understood and commonly agreed upon theory for what a particular type of information means for the price of a security. If the earnings go up by 2%, should the stock go up by 2% or 4% or 6%? We don't have any universally agreed upon formulae for this. Whereas when it comes to, okay, how do you boil water? You apply heat to it and then raise the temperature to 100 Celsius at sea level and it boils. Okay, nobody is going to argue with this. Whereas in stock trading, so when we talk about market efficiency, this is the real problem, the fallibility in predicting the future. Okay, wrong in his estimate of the future. This is true of anyone. It could be Warren Buffett, it could be just your local, you know, egg seller or something like that. Everybody can be wrong, and the probability of being wrong is not really different if you're Warren Buffett. So pretty much everybody can be wrong. So that's the real problem. This the market efficiency itself is a vague concept. So, but people talk about it, so you should understand what it means. When he's talking about, um, yeah, current year's results or next year's results are already being fully considered. So what he's talking about here is basically he's talking about market efficiency. Okay, we already discussed the efficient market hypothesis. You know what it is, but as I already pointed out to you, it's not very precise. If you really dig deep down, but you should understand it at the superficial level at which the market considers the idea. So you should be aware of what. So somebody asked you in an interview, what is the efficient market hypothesis? Don't tell them that our teacher told us that it's not a sufficiently precise idea. Tell them what they expect to hear, that this means that, if the market is efficient, that means that all the relevant information that is publicly available, if the market is semi-strong from efficient, then all the publicly available fundamental information, like earnings, what products are they developing, new battery plant being set up by Tesla, all this kind of information, everything is factored into new orders that Micron Technology has. Everything is already factored into the price. All publicly available fundamental information is factored into the price. Semi-strong prom efficiency. So that's what it means. So you just answer it like that. So you should know what it is, or at least at a superficial level. But also understand that deep down, when you dig into it, it's not really a very precise theory, because you can't really say what it means for something to be factored into the price. Okay, this is here. Yeah, so again, it's the same problem here. Outright error in the prediction is anytime you're predicting the future, it's fraught with error, actually. And the longer term you go in terms of your prediction horizon, the more problematic it is, because the more things that can happen that can go, make everything go wrong. So there's more time for, bad things to happen. So when you're going long term, so therefore, and the combinations are also, much, orders of magnitude higher. So like one bad thing happens in period 2, then another bad thing happens in period 3, and that combines with another bad thing that happens in period 4. And then the outcome in period 5 is so far away from what you could have imagined in period 0 that, almost the whole exercise of trying to predict becomes a joke. So, but that does not mean that we shouldn't predict. We can make reasonable bets. There are many ways to play the market. If you are disciplined and you have tight stops, you can still make money. So, but you should be aware that the prediction error rates are very, very high. So you have to play accordingly. Lots of focus has to be given to risk management. So here we have inherently sound and promising. They're very general statements, actually. Yeah, now you see this term, discrepancies between price and value. See, here it comes to the heart of this distinction that I taught you, that value investing is really, first you have to understand this price versus fair value paradigm, and this whole game between price and fair value. So this value here is fair value, and you have to understand how it works. That the example that I gave you the other day, even NPV analysis can fall into that framework, your project selection and rejection. And this is basically, he's bringing you back to this idea of distinction between price. So what he's basically saying here is the market swings around quite erratically, and therefore it may frequently come to a situation where price is maybe far away from fair value. So if we go to my favorite blue chip company, yeah, there you see General Electric looking not too hot. Okay, look at General Electric now. So you could say that, well, the fair value of General Electric is $300, but it's trading at $100. This is because the market is stupid and it has sold down the stock without understanding the true value of the stock. So I'm going to buy it here and wait for it to move to 300. Okay. So this is basically what he's talking about here. So we'll stop it here because it's 6 o'clock. So this is crossed over by 40 minutes, 40 seconds. All right. So we'll stop it here. Discrepancy between price and value. So we'll just stop it at page 45. We'll say page 45. As page 45 is our ending. All right. And yeah. End of today is what? 29. Page 45 we have ended. All right. So we ended here. So those who so the class is dismissed. We are down to 34 actually. Now during the attendance we had about 43. Now we're down to 34. Okay. So we are so anybody has any questions? Now there's some message in the chat box. What is it? Okay, Shobit has a network issue. Okay, right. So okay, folks. So and whoever there are classes dismissed, so you guys can leave, and whoever has questions can stay back. And so our next, please remember now, folks, and please tell everybody through posting in your WhatsApp groups and all that. All classes, so until further notice, all classes will be in Google Meet. So I hope that those who are not coming are not because they don't know where the classes are going to be held. Okay, I hope everybody knows by. Anybody wants to say that? I hope nobody is saying that people who are not coming are not aware of the fact that Google Meet is where we are having our classes, right? That's not true. So if it is true, please tell me. Okay. If I don't hear anything, I assume that everybody knows that it's on Google Meet and I'm sending you the links. Today I sent it a little late. I'll try to send it a little earlier now. But okay. All right. So any questions, folks? People are leaving. That's fine. I've allowed the class, dismissed the class. Anybody has any questions? How is the audio? Can somebody give me some kind of a positive response before leaving? How is the audio?
So it was good, better than
Okay.
It was good, sir.
Okay, and no network interruptions. Nobody had any visual problems with seeing the screen. Audio was clean all through.
Yes, sir.
Yes,
Okay,
sir.
good.
Yes,
So
sir.
far that means the switch to Teams is working. So I've also made I've told the director also that it's a very good platform. The audio is very clear because most of the time the class is silent. So I hope you're always ready to ask questions. Okay, so I think by now it's pretty clear that I welcome questions. So anytime you have a question, you should feel free to ask. So if you're listening quietly and not asking questions, that means I assume that you're understanding whatever I'm saying. Okay, any questions, folks, or should we stop recording? Yeah, we are done. Then no questions. Then we'll stop recording. Next class is whenever it is. I think we can find out from our dearly beloved Creatrix. Where is it? Next class. Next class is Thursday, 1 p.m. Okay. All right. So I'll see you guys on 23rd September, Thursday at 1 p.m. Okay. So I'm going to stop recording now. Stop recording. Stop recording.